Welcome to The Explainer. Look, before we open the books on today's massive institutional audit, we have to do a mandatory compliance check. This deep dive is strictly for educational, informational, and case study purposes only. It absolutely does not constitute financial advice, a formal recommendation, or an offer or solicitation to buy or sell any stocks or securities. We're here to analyze the hard data as researchers, not to tell you what to do with your portfolio. All right, compliance check cleared. Let's look at the asset on our desk today. We are staring down a massive stack of earnings reports, SEC filings, and forensic data to decode the hidden machinery of global shipping. Today, we're doing a rigorous, objective teardown of global ship lease, or GSL. We're going to strip away the corporate hype and look purely at the hard data, the strategic choices, and the real economic mechanics found in our institutional sources. Here is today's agenda. 1. Disclaimer and landlord model. 2. Operations and cash flow. 3. The geopolitical growth catalyst. 4. Forensic audit and risks. And finally, 5. The risk-return trilemma. Let's get right to it.
Section 1. Disclaimer and landlord model. The economic mechanics.
Okay, to properly analyze GSL, we have to completely ditch the confusing maritime jargon and just look at the pure business model. The absolute easiest way to understand this is through a real estate analogy. GSL operates as what the shipping industry calls a tonnage provider. Basically, they're a maritime landlord. They own mid-sized container ships and they lease them out on fixed-rate time charters to global container liner majors. Think giants like Maersk or CMA CGM. It's really just like renting out a house. GSL holds the structural mortgage and covers the basic maintenance, but their massive corporate tenants pay a fixed daily rent and cover all of their own operating utilities, which in this world means incredibly heavy expenses like fuel and canal tolls.
Section 2. Operations and cash flow. Balance sheet deleveraging.
On paper, that sounds like a very clean setup, right? Well, let's pivot to the hard financial data to see how that model is actually performing. Check out this number, $2.1 billion. That is GSL's massive contracted revenue backlog as of the end of the first quarter of 2026. Because they locked their tenants into these multi-year fixed-rate time charters, they've secured unbelievable forward visibility. We're looking at a weighted average remaining term of 2.6 years on those contracts. That gives them 100% charter coverage for 2026 and 86% coverage for 2027. They know exactly what cash is coming in.
And they haven't just been hoarding that cash either. They've been systematically paying down their debt. Which brings us to this, 0.3x. That's their dramatically improved debt-to-equity ratio. If you look back to 2018, their net financial leverage was sky-high at 8.4x. They've run a massive, aggressive deleveraging campaign to push that down to just 0.3x today. That is an incredibly structurally sound position to be in.
The crucial takeaway here is that their balance sheet is absolutely pristine. They have 23 completely unencumbered, debt-free vessels sitting as pure collateral. Their Q1 2026 operating revenue bumped up to $198.1 million. And yet, despite this highly profitable setup, Wall Street held the company's price-to-earnings ratio sitting at an absurdly low 3.34x. The market is aggressively discounting this asset.
Section 3. The geopolitical growth catalyst, artificial supply sinks.
We have to ask why the market is discounting them so heavily. To properly contextualize these pristine numbers, we absolutely must look at the external macroeconomic forces currently driving this profitability. It is not happening in a vacuum. You have to compare a normal shipping transit through the Suez Canal with the massive detours happening right now around Africa's Cape of Good Hope, all due to the geopolitical disruptions in the Red Sea. Looking at this neutrally, as a pure market dynamic, forcing ships around the Cape adds 10 to 14 days to a single voyage. That logistical shock acts as a massive structural sink, artificially absorbing 10 to 15% of total global shipping capacity. The global fleet is literally tied up in transit.
And that external chaos? It translates directly to GSL's bottom line. Because global capacity is artificially constrained by these long detours, demand for GSL's available mid-sized ships is off the charts. This structural shock has driven GSL's fleet utilization up to a staggering 98.2%. These ships are practically never sitting idle.
Section 4. Forensic audit and risks, the structural threats.
This is where we officially open the forensic audit phase. We need to step away from the top-line hype and those geopolitical tailwinds to expose the underlying long-term structural constraints of this company. And the customer concentration data is honestly pretty sobering. Look at this breakdown. Maersk is at over 29%, CMA CGM at nearly 21%, Hapag-Lloyd around 18.6%.
Over 81% of GSL's entire operating revenue is wholly dependent on just 4 global liner companies. If a synchronized collapse in global consumer demand happens right as the Red Sea situation resolves, and one of these major counterparties demands a charter rate renegotiation, well, GSL is highly vulnerable. Their $2.1 billion backlog is literally only as bulletproof as the credit of those 4 specific tenants.
And this extreme concentration is exactly why the institutional audit framework flags their core business model as a primary risk category. In fact, the forensic framework assigns this specific model a medium risk rating.
The justification explicitly calls out this core tension. Let me read it to you directly. Heavily insulated in the near term by fixed-rate time charters, but structurally exposed to long-term shipping capacity cycles and rate volatility. Basically, if the Suez Canal reopens peacefully, all that artificial demand evaporates overnight, and GSL will eventually have to renew its leases in a completely flooded market.
Let's rapid-fire some of the other forensic red flags we uncovered in their filings. First up, related party friction. GSL outsources their technical and commercial management to privately held companies, Technomar and Conchart, that are closely associated with GSL insiders. This creates serious agency risk where public equity profits can be subtly siphoned off as management fees. Second, overhead inflation. Their Q1 2026 general and administrative expenses almost doubled to $8.8 million year over year. That is a major escalation in overhead relative to their modest 3.7% revenue growth. And finally, regulatory liabilities. The audit reveals over $34 million in receivables tied up entirely in European Union carbon compliance. If they face disputes trying to pass those environmental costs on to their charterers, that's a sudden multi-million-dollar hit straight to their working capital. Section 5. The Risk-Return Trilemma, the ultimate verdict.
Which brings us to the end. How should an investor actually price a maritime asset with such extreme polarities? You've got a pristine, deleveraged balance sheet with a massive cash backlog on one hand, and extreme customer concentration with looming geopolitical and regulatory cliffs on the other. So we pose the ultimate strategic question to you. Which risk profile does GSL actually fit? We've laid out the hard numbers and the structural threats. Now we challenge you to weigh the evidence.
We evaluate companies against 3 distinct profiles. Profile 1 is low risk, low return. This is your stable, mature business or utility play. Does GSL's $2.1 billion fixed-rate backlog and 0.3x leverage make it a low-risk landlord simply collecting rent? Or is it Profile 2, low-risk, high-return, the holy grail, a rare, wide-moat business with highly asymmetric upside and protected downsides? With a PE ratio under 3.5 and 23 completely unencumbered vessels, are you basically buying a protected cash machine at a massive discount? Or is it Profile 3, high-risk, high-return, a venture-scale, binary bet? If the Red Sea reopens, if 15% of global shipping capacity suddenly floods the market, and if Maersk or CMA CGM decide to aggressively renegotiate those leases, could that stock price crater back to historical lows, making this a highly dangerous cyclical trap?
We are intentionally not going to give you a definitive answer today. The evidence is on the table, and we're turning this interactive challenge exclusively over to you, the viewer. Is this company a Type 1, Type 2, or Type 3 investment? Is GSL a resilient, deleveraged cash machine systematically optimizing its fleet? Or is it just a pristine balance sheet temporarily propped up by geopolitical chaos, totally vulnerable to extreme customer concentration? Based on the forensic evidence we presented, you decide. Thanks for joining us on this explainer, and we'll catch you next time.